Okay, so medical expenses. As I had mentioned, medical expenses, so there are a couple of thresholds that you have to exceed before you can take advantage of medical expenses. First off, you have to itemize your deductions, right? If you don't itemize your deductions, then your medical expenses aren't deductible to you, so you don't have to worry about doing all the calculations and all of that. So that's the first threshold for all of these deductions is, do you even need to itemize your deductions? The second threshold, though, that you have to exceed with regard to medical expenses is you can only deduct those medical expenses that exceed 7.5% of your adjusted gross income. This is where trying to get that adjusted gross income down as low as you can comes in handy with other types of deductions. So, if your AGI is, let's say, I'll make it easy on myself, $100,000. 7.5% of that is $7,500. If your medical expenses are $5,000, they're not going to help you out because it's not more than $7,500. If your medical expenses are $15,000, you only get to take, we got to subtract that, 7,500, you only get to take 7,500 as a deduction. So you can have quite substantial medical expenses, but if your adjusted gross income is high, there's a very good chance that you're not really going to get any tax benefit from those medical expenses. Most people who get a benefit from a tax benefit from medical expenses are individuals in nursing homes. So because a large chunk of the expense for nursing homes is for medical expenses. People who have had catastrophic medical events during the year, that sort of thing. So you gotta be kind of down on your luck in order to get a tax advantage, obviously, for medical expenses. But that's a pretty big threshold to have to get over. First off, you gotta itemize your deductions. So like if you're single, your total itemized deductions have to be more than $13,850 for you to even worry about this. And then your medical expenses have to exceed that 7.5% of adjusted gross income threshold as well in order to take advantage of that deduction. So now we have to determine whose medical expenses. Anybody on the tax return would count. So if it's two spouses, any of those spouses, any dependents that are listed on the tax return. There are a couple situations though where even individuals who aren't on the tax return, medical expenses that were paid on their behalf can be deductible. So dependent child of divorced parents, for medical expense purposes, they are treated as a dependent of both parents. So for example, if you've got a child and there's shared custody, and it doesn't even have to be shared custody, but in this example, shared custody, and the child is getting, let's say they've got braces, orthodontia, and each parent has to pay half. Well, the child's only going to be a dependent on one of those tax returns. But even the parent for whom that child is not a dependent can claim the expenses as a medical expense, those orthodontia expenses. Excuse me. Also, the gross income and the joint return test for the dependency exemption are waived. So if you have a dependent who doesn't meets all other tests but doesn't meet the joint return test or the gross income test, they can still be considered a dependent for medical expenses. Okay, so you got that adult child who's still living with you, but they made $10,000 during the year, but you paid for their, they're not a full-time student, but you paid for their medical expenses, maybe their medical insurance or something like that, then in that case, you can also claim their medical expenses. Medical insurance does count. Now, before with the HSAs, I said you can't pay for medical insurance through HSA funds, but you can get a deduction for medical insurance premiums that have been paid under the medical expense deduction here on the Schedule A. Medical expenses have to be actually paid during the taxable year, regardless of when the care was provided, regardless of the taxpayer's method of accounting. So if you're in the hospital and you get a bill from the hospital for $1,500, you put it on your credit card in December, the bill doesn't actually come due until January. In that case, actually, you get to claim it when it was charged. So otherwise, if you're paying it, if you didn't charge it in December, even though you incurred it in December, and you pay it in January, it's going to be deductible in January. But if you put it on your credit card in December, that's considered paid in December. Does that make sense? I kind of confused as I was how I was saying that. Okay, so what exactly is our medical expenses? Deductible medical expenses? Is it anything and everything? Not necessarily. So if it's for the diagnosis, cure, mitigation, treatment, or prevention of disease, or for the purpose of affecting any structure or function of the body. That's a pretty broad term, affecting the structure or function of the body. Transportation primarily for and essential to medical care. So the transportation to get to that medical care is also deductible. Qualified long-term care services, that's that nursing home that I was talking about. Insurance for medical care or qualified long-term care services. So that includes dental insurance and vision insurance as well. Also, under Category 1, that includes dental care, orthodontia, it includes ophthalmologists, optometrists, that sort of thing as well. So it's a pretty broad definition. Also can include acupuncture, chiropractic as well. It could include massage therapy if it was prescribed by a doctor. Okay, so but remember, you gotta get over those couple of thresholds, those dollar thresholds anyway. So usually there is some, I'm not gonna go through the COVID stuff, PPE, that all counts as well, but you still have to get over the 7.5% of AGI. So here's kind of a scenario. So a physician prescribes a special diet consisting of low-fat, high-fiber foods to lower cholesterol. The physician's bill in this case is deductible. However, what about the cost of the food as a medical expense? The only costs that would be deductible are those costs that would be over and above the normal costs. So if you end up paying more for that food, because it was prescribed by a doctor, then you would get to deduct the amount that's over and above. So if your normal grocery bill is $150 a week, and now your grocery bill is $200 a week, $50 a week of that would be considered deductible. But again, you still gotta get over the 7.5% of AGI, and you still have to itemize your deductions in order to take advantage of it. So any additional cost, as long again as it's prescribed by a doctor. If you just decide, hey, I need to lose some weight, I wouldn't do low fat if you wanted to lose weight, by the way, but so you're going to high protein or high fiber. You decide to do that just on your own, that would not count, right? It has to be prescribed by a physician. Also prescriptions would also fall under that umbrella of medical services. So anything that is prescribed by a physician, even if it's an over-the-counter, if the physician prescribed it. So if you've got something over the counter that you take and you do already itemize your deductions, you should have that doctor write out a prescription for it, right? Something on you don't send it in, by the way, you don't send any of this stuff in with your tax return. It's just in case that you're audited, then you've got the substantiation for all of it. cannot deduct expenditures that are merely for the benefit of the general health of an individual. So, an example here, cosmetic surgery is generally not deductible. So you can't just go out and get a nose job because you don't like your nose. However, if it is to correct something, so you want that nose job, you've got a deviated septum. So the doctor has to go in and fix the nose because of a structure, and in the meantime, you get a nose job out of that as well. In that case, they're fixing something for the structure of it. Same thing with like reparative surgery, so like mastectomies, double mastectomies, and then restorative surgeries for that would be considered a medical expense in that case. But if you're just doing it because you don't like the way you look, then that doesn't count. So if it's to repair a birth defect or like an illness, something that occurred because of an illness or an accident, then that would count. And I mentioned here, unconventional treatments would be included, so acupuncture and treatments by Christian Science practitioners as well. So what about capital improvements? So you've got, say your doctor says that you need to start swimming for your arthritis. And so you decide to put in a swimming pool in your house. Well, it depends. It's the answer to everything, right? It depends. If the expenditure is for the primary medical care of somebody on that tax return, it could qualify. So, and obviously, as they mentioned here, this has been highly litigated by the IRS, because who doesn't want to put in a swimming pool and then have it be tax deductible, right? So a physician has to prescribe it. There can be no recreational element to it. So you can't put in a diving board or anything fun, no slides or anything like that. Also, you need to determine whether or not you have other pools available, other types of activities that could substitute for this particular type of recreation. But let's just say, for the sake of argument, that it qualifies, that you can do this. How much do you get to deduct? So you have to compare the increase in fair market value of your home from putting the swimming pool in, from installing the swimming pool, to the value of the pool. So you find the fair market value of your residence before installing the pool, and then you determine what the fair market value of your residence is after installing the pool. And then you compare that to what you actually paid for installing the pool to determine what the value of the deduction would be. So in this example, cost of swimming pool for medical purposes was $30,000. Increase in the fair market value to the residence was $20,000. So in that case, you would get a $10,000 deduction for the cost of the pool. You don't get the full $30,000. It's only the additional, or actually the amount that you spent that did not result in an increase in the fair market value. And there are certain situations where things, like think about a chairlift. Sometimes, you see those chairlifts for elderly. That's not going to increase the value of your house. It very well could decrease the value of your house if you're trying to sell it. So in that case, probably the whole value, the whole cost of it would be considered a medical expense. So here we've got Surita. Has a knee condition, unable to climb steps, installed an elevator, right? I'm assuming it's a chairlift. In her home, cost of $7,000. Appraiser indicates that the elevator increased the value of the home, excuse me, by $2,000. So in this case, $5,000 is deductible to her, provided it was prescribed and there was no other way to do this, and yada, yada, yada. And you itemize deductions and you meet that 7.5% of adjusted gross income floor and all that stuff. Talks about cosmetic surgery here. We already kind of talked about that. That it would be considered a deductible medical expense if it wasn't simply for cosmetic purposes, if it was to fix a structure that have been damaged somehow. Medicine and drugs, physician has to prescribe it. I gave a couple of examples there. The taxpayer also has to obtain the drug legally in the jurisdiction in which they live. Think medical marijuana. So if you have a prescription for medical marijuana, and in Iowa's weird with their medical marijuana laws. They're pretty conservative. They're very conservative. I think medical or recreational marijuana is legal in most of the states now. Iowa's very, very stringent about it. So if you have a prescription for it, but it's not legal in the jurisdiction in which you live, it is not deductible. The costs of it are not deductible to you. Okay. Prescription drugs obtained from sources outside the U.S., such as Canada, are deductible if they're prescribed by a physician for the treatment of a medical condition and the FDA has approved that they can be legally imported. That didn't used to be the case. You used to not be able to get those prescriptions outside of the U.S. Now they talk about marijuana here. All right. Another aspect of medical expenses, travel and transportation expenses for medical purposes. So if you have to travel in order to obtain medical services, then the cost of that travel and transportation, you'll see, we'll talk about this more in chapter 6 too, the distinction between travel and transportation expenses. So travel generally involves some sort of overnight with it. Transportation is more local. So the cost, the things like taking a cab, bus, train fares, personal auto, airfare, that sort of thing. But the cost of the transportation has to be primarily for and essential to otherwise deductible medical care. Okay. So we got an example here of Jack, currently lives in New Orleans, has to fly to Memphis to see a specialist concerning an inner ear condition. His spouse, a big Elvis fan, decides to go along to visit Graceland. Travel costs for Jake are deductible. Travel costs for his spouse are not deductible as a medical expense. However, if the spouse's assistance is required on the trip due to problems stemming from that ear condition, then the spouse's cost would also be deductible. There are two different ways to determine expenses you can use when it comes to transportation and automobile expenses. You can keep track of actual expenses, so gas, oil changes. They talk about oil changes. Gas, oil changes, that sort of thing. Usually for medical purposes, we're talking about gas. Or you can take them per mileage rate, which is determined already by the IRS. So when you use the actual cost, the taxpayer has to keep receipts for those things, for all of those expenses. But there's no deduction for general repairs, maintenance, or insurance on the vehicle. So just essentially gas, oil repairs, that's not general repairs, but specific repairs. It's a lot simpler to use the standard mileage allowance. It's 22 cents per mile. That changes every year, that 22 cents. And you'll find when we start talking about, well, in this chapter, we'll talk about charitable contributions. There's a mileage rate for charity as well. It's different. There's a charity rate for business, which is a different rate as well. So they have different rates for these different purposes. In this case, for medical, it's 22 cents a mile. So you do still have to keep track of your mileage, kind of put it in a log to determine, and you can do a comparison. I think this one is a comparison here between the two different methods. So we got Maria, inoperable brain tumor requires treatment, University Medical Center in Houston every other month. It's done throughout the year. 500-mile round trip. She pays a total of $10 in tolls, $20 in parking, $95 for gas on each trip. Assuming that she made the trip 6 times in the current year, excuse me, maximum transportation deduction for medical purposes we can compare. So if it was actual costs, $95 per trip times 6 trips, $570, tolls, same thing, parking, same, total deduction of $750. Using the standard mileage rate, we would take the 500 miles that she traveled times 22 cents a mile, times 6 trips. She made 6 trips, they're each 500 miles. She still gets to take the tolls. That's over and above the mileage rate. And the parking, again, total deduction in this case is $840. So it would be better for her to take the standard mileage rate in this case. Again, she still has to get over that 7.5% of adjusted gross income, and she still has to itemize her deductions. All right. Costs of meals and lodging at a hospital is also deductible. However, there's a limit. The lodging expenditures are limited to $50 per night for each individual, up to 2 individuals. So $100. You can find me a hotel that's $100 a night. I will not stay there. It's not going to be very nice. So it's a pretty chintzy deduction. And again, what we're talking about here is the deduction. You got to meet the other requirements, the monetary threshold for it, and then if you actually get it, it's only going to reduce your taxable income. It doesn't directly reduce your tax, right? It's only going to be a percentage of your tax that is reduced. So the meals, you have to be there to receive, specifically to receive medical care. So the principal reason has to be that. Long-term care, as I mentioned before, so long-term care, individuals who are in nursing homes, assisted living facilities, and independent living facilities for seniors will usually have a medical component to it as well. And oftentimes what happens at the end of the year, those facilities will calculate for the families of residents exactly how much of their care was devoted to medical services, because they know they need this information in order to file their tax returns. Obviously, those types of services can be extremely expensive. You know, we're talking tens of thousands, if not hundreds of thousands of dollars a year. If it's paid out of pocket, you would reduce it by the amount of any insurance that was received in order to pay for those expenses. Health insurance premiums as well. So health insurance premiums are deductible as long as they weren't paid for pre-tax through your employer. Meaning you didn't get, you can't double dip. You can't get 2 benefits for it. If you are paying for your health insurance premiums through your employer, and you are getting a tax benefit, they're pre-tax, so that you don't get taxed on the amount that you're paying. I'm saying that wrong. So by pre-tax, I mean that the tax is calculated after, well, that sounds right. That doesn't sound right. Let me write it down. It's easier to explain. A lot of you who've had payroll already remember this concept, but for just to kind of refresh your memory, or if you haven't had it yet. So your gross pay minus pre-tax benefits equals our taxable pay. Health insurance may be one of those pre-tax benefits. So if your gross pay was $1,000 and you paid $250, and this is where the employee pays it, $250 out of that $100 for health insurance, your tax, your withholding, your income tax was based on this $750, not based on the $1,000. That's a pre-tax benefit. So if you paid for it through a pre-tax benefit, you do not get a deduction for it, because you already got the tax benefit. And this is a better deal anyway, because this is also reducing your Social Security and Medicare taxes, right? And you're getting 100% of the benefit rather than only the amount that's over 7.5%. Or if the employer pays for your health insurance, then you do not get that deduction. But if you just pay for it out of pocket, you write a check every month to the insurance company and that's how you're paying for it, that is included in the medical expense deduction. If you're not self-employed, remember we talked about the self-employed health insurance, which we're gonna talk more about in the next chapter too, then you're gonna get a different benefit. You're gonna get that as a before AGI benefit, right? This is for employees or retirees who pay for their health insurance. Medicare premiums can be deducted in this manner. So, insurance for long-term care as well, but there is a limit based on your age. So this is the limit to the amount that is deductible, okay? That doesn't mean that that's what the premiums are gonna be. The premiums are probably more than that, but that's the amount that you get to deduct based on your age. What else do I wanna say? So here's an example of, with all that information, how that would look on the form, that little spot on the Schedule A that we talked about. So here we would list our total medical expenses, medical and dental, all the medical expenses, AGI, which comes from the front of the Form 1040, and then here's the calculation, 7.5% of that AGI, 8254, that means that this would be, we have to subtract this from this in order to get our deductible medical expenses. And all the instructions are right there on the form. By the way, it tells you, subtract line 3 from line 1. If line 3 is more than line 1, enter 0, you get nothing. So, if this AGI was higher, it means that this would be lower. So there are two ways to make this larger, have more expenses or have a lower AGI. That make sense? Okay. Questions? What else do I want to say here? Anything? Oh, I guess I should mention this. So any medical reimbursements, you have to offset those expenses. So if you got, a payment from insurance, you'd have to subtract that out. If you receive the insurance benefits in a different year, then the insurance reimbursement would be included in income in the year that you received it, to the extent that you had a tax benefit in the prior year. So if you didn't itemize your deductions and you got an insurance reimbursement in a different year, you don't have to include it in income because you never got a tax benefit from it. Okay. Let's see. Questions? That's a lot about medical expenses.